All right, so now let's start looking at things through the prism of margin ratios. So we're on part 2 of this chapter, and I'm starting margins out on page 21, which is where we dropped off from part 1. Okay, so what do we mean by a margin ratio? A margin ratio is going to be some income statement quantity or cash flow statement quantity divided by another income statement or cash flow statement quantity. Very often, not always, but very often, a margin ratio is some kind of expense or earning measure divided by sales. Okay, so first up, profit margin. This is the most important. Let's see what we got here. Okay, this is our most important margin ratio. So this is net income over sales, also called the net income margin. So let's think about this in terms of our three things. We want to have one sentence that describes the essence of this and implies why it's important. So this is something like how much profit we can extract from our revenue, where we remember that revenue and sales mean the exact same thing. Okay, so for this, is bigger better or is smaller better? As always, keep the denominator constant. If the numerator increases, is it better? Yeah, definitely. We're getting more income for a constant amount of sales. So in this case, we want to say bigger is better. And do we have a knife edge? Yeah, we talked about this a little bit briefly before. In this case, if your net income is 0, your profit margin will be 0, and below that is definitely bad. You have some hope, at least, if it's better than that. So knife edge at 0. Okay, so now let's go back to grammar school or high school when we were all first doing algebra and fractions and things like that. So for this ratio, what two things, just algebraically, okay, forget finance, forget accounting, algebraically, what two things could make this ratio bigger? Well, obviously, if the numerator gets bigger, that will make the ratio bigger. But also, if the numerator were to stay the same and the denominator got smaller, okay? And that's going to be true in this case. Both of these things are possible in this case. And great thing about finance is that the math and the algebra always work. So if you can envision something happening, it's either happened in finance or some financial engineer is working to make it happen probably as we speak. Okay, so we can increase our net income margin by increasing net income, right? Or we could also do it by what? By reducing sales. And that seems totally counterintuitive, right? But it's true, it's really true. In a case like this, we would want to reduce the sales of maybe our lowest margin product if we have more than one product. And as a result, our net income margin, our profit margin will increase. So let's see how this works. Let's do a margin example, okay? And this is a good investment banking kind of example. So if you think you might be interested in investment banking or you just want to know about what investment bankers do, this is also a great example for you. So let's look at Vermont Organic Apples, LLC. Okay, they're up near Burlington, Vermont, and they own some apple orchards, and they've got two products that they sell from those orchards. They sell apples, like you can see right here, and they also sell apple butter. They make their own apple butter and they sell it. Okay, so here's their income statement from Q4 in the year 20X0. So what do they got? They've got revenue of $20,000. They've got cost of goods sold expense of $14,000. and they've got other expenses like their accountants and stuff like that of $1,000. So 20 minus 14 minus 1, that's 5. So I think from that we can compute the profit margin or the net income margin. And if we do that, that would be 5 over 20. Okay, and in most circles, that's equal to 25%. So that's looking good. That's a pretty decent profit margin. Remember, well, you may have not learned this yet, but you're about to learn it right now. If your entity is an LLC, you don't pay any income tax at the LLC level. That's why there's no income tax line. They're the owners of the LLC. They are going to pay tax on this profit, but on their personal income statements. Okay, their personal tax returns, that is. All right, so let's say that we're up there minding our own business, okay, near Burlington, Vermont, and we've got our Organic Apples LLC company, and we have a friend we have coffee with every now and then who is the local investment banker, and he says, let me look at your business and see maybe I can help you improve it in some way. Well, it's like a farm and an apple butter business, but yeah, whatever, knock yourself out, okay. And typically the investment banker is not going to charge anything for this analysis. So the investment banker comes up with this analysis, which is actually pretty good, reasonable analysis, okay? He notes that we could separate these two businesses and look at them independently, the selling apples business and the apple butter business. So he goes ahead and breaks them apart. So the company last year got 10,000 from selling apples, 10,000 from selling apple butter. But here's the interesting thing. The COGS expense for selling apples was just 5, and the COGS expense for selling the apple butter was 9,000. Okay, so we see we're looking more deeply into that 14,000. And then we have the other expenses, et cetera, et cetera. So the investment banker, being good investment banker that he is, comes up with the idea that, hey, you could jettison this lower margin investment apple butter business, keeping only the apples business, and look what would happen to your profit margin if you did that. It would go from 25% to 40%, right? And 40% comes from what? 4 over 10, right? And so that's pretty amazing. So his pitch goes like this. Listen, you're really a farmer, okay? You need to stick to your knitting, all right? You are not in the business of being a manufacturer, making apple butter. You have a kitchen that's not really up to speed. What if something goes wrong and you get some botulism in that apple butter? You have very, very high risk with that, right? People could die, you get sued, you'd be in big trouble. So I suggest you stick to your knitting, you sell off this apple butter business, and you'll get a big pile of money for selling off the apple butter business, and you'll be left with, in addition, a much more profitable operating business. And of course, the investment banker gets a big fee on the sale of the apple business. That's how they make their money, okay? And maybe you say, okay, that's really good, that's great, and that might be a reasonable thing to do. So what does the investment banker do after that? The investment banker keeps you in his Rolodex, and he waits for about 10 years, and at that point, your children are running the business, and he comes back to them with another pitch. He says, you know what? You guys really need to diversify. You have a huge amount of risk in this apples only business. You get all your revenue in the fourth quarter, and if nature deals you a bad card, if you have, for example, late heavy frost, you might have your apple volume down by 50%, your revenue down by 50% in a given year. You need to diversify into something like an apple butter business. If you put some of your apples into making apple butter, now what are you going to have? You're going to have revenue 12 months throughout the year. And if you have a bad year with apple harvest, you can still make up some of it by selling the inventory of your apple butter. And of course, the investment banker once again gets a big fee when you purchase that apple butter business. In this case, he'd be getting the fee from the seller, not from you. But that's what investment bankers do. They could care less what is best for the business or the big bad world in general. They care about whatever it takes, whatever pitch they need to make to get their fee. And we'll contrast them with other folks in the financial community, like, for example, private equity folks who are much maligned, but they actually can do an awful lot of good in the world of finance and the more general world that we all live in. So more about that later. All right, so let's move on. So next margin that we've got going in our margin ratio section is the COGS margin, and some people look at gross margin instead. We're gonna focus on the COGS margin. So COGS margin is just our cost of goods sold expense divided by sales. And just FYI, this is very related to the gross margin, which is sales minus COGS over sales. And you can always note that the COGS margin plus the gross margin add up to 1. But again, we're going to be working in this chapter mostly with just our COGS margin. Okay, so what are our 3 big things about the COGS margin? So what is COGS, right? So COGS is cost of inventory that we've sold, right? So remember, when we buy inventory, it becomes that asset, and then when we sell it, we credit that asset, we subtract that asset out because we don't have it anymore. That would be fraud jail, that would be bad. And where does it go? It goes to COGS expense. So important to know what COGS is. Again, I'm counting on you all to know and have learned your financial accounting. So what can we say about COGS in one sentence? It's measuring the size of our direct production costs relative to sales. Inventory costs are our direct production costs, certainly for something like Vermont apples. Clearly, this ratio is not going to work so well for a service company that doesn't have any inventory, doesn't have any cost of goods sold. And that's true of all our ratios. They're not going to work for everything, right? So this is going to work for industrial types of companies that have inventory, that have tangible products, and their cost of goods sold. Okay, so that's number 1. Okay, so is bigger better, smaller better? Okay, so just hold that denominator constant. If our COGS expense goes up, ooh, that's bad, right? Okay, so we want smaller to be better. All right, so we got smaller in this case. And I guess we could sort of say maybe knife at 1.0. I say maybe because it's unlikely that we're going to get there. If your cost of goods sold expense is the same as your sales, you're probably in the wrong business, or you're doing an extraordinarily bad job at managing your operations. Okay, so what do we want to do with COGS? We always want to compare it to our history and to comp. So it's answering great questions like this. Are purchasing and plant operations getting more efficient or less efficient? Great thing to know just from that one ratio, looking at its movement historically. And then similarly, we can benchmark ourselves against our competitors, right? Are our purchasing and production operations better or worse than our comps? Excellent. Okay, and the COGS margin also tells us sort of kind of how big our variable costs are. Okay, and hopefully all of you remember from being tortured in microeconomics, variable costs are costs that scale in proportion to sales. So all things being equal, remember COGS comes right out of your inventory. Your inventory is what you're selling. So COGS is going to be scaling pretty much in proportion to sales. And it's a good first order measure of variable cost for an industrial firm. Okay, anything in gray, right? Any slide in gray, we're going to skip. So we're skipping SGA margin, we're skipping interest margin, and we're zooming right along to effective tax rate. So I pre-filled in a couple things for us on this slide, just based on previous questions. The percent here, so I've got effective tax rate is equal to tax expense over earnings before tax, or EBT. The percent here just means it's usually reported as a percent, okay? No funny business about that. And again here, EBT which hopefully you remember from financial accounting is short for earnings before tax. Okay, so that's your revenue minus all your expenses except for tax. So what's it doing for us? Here's our sentence describing what's important about it. How much of our earnings go to the government? That simple. Okay, and then also we can think about, is our tax rate lower or higher than our comparables? If they really are comparables, our tax rate should be about the same. So we might want to think about, if their tax rate is much lower than ours, why that's true. Maybe they have a lot of debt, which gives them a tax shield, which we'll talk about later, things like that. Okay, so our three things, okay, so number one is C star above. Okay, and let's just put a star up here because that's telling us what's important about that. Okay, and for number two, we have definitely smaller is better, right? And for number three, there's really no good knife edge. I mean, you could say your tax expense equals your earnings before tax. That's unlikely. So we could say greater than 1 is bad, but unlikely. All right, so that's it for effective tax rate. So now what I want to do is I want to go back to our analysis of United versus Southwest, UAL versus Love, and I've got some of our margin ratios for them, and I want us to be able to look at them and answer some compelling questions about them. Okay, so remember the way it works. Q1, most recent quarter, TTM, 12 trailing months, which is the effect of Q4, Q3, Q2, Q1. And let's answer these questions. So who had the better profitability on average? Why? Remember, the first row here for each ratio is always going to be UAL, and the second one is always going to be Southwest. Okay, so during the last year, all these questions are going to be for during the last year. So that means that we're focused on this area. Okay, who has the better profitability? So first of all, what ratio do we want to look at here? We got profit margin, COGS margin, SGA, interest, tax rate. Clearly, it's profit margin. Okay, so on average, that is going to always imply look at TTM. Okay, last year on average, go for TTM. So what have I got here? I've got the average profit for UAL up here, and I've got the average profit for Love for the past year right underneath it. So we can clearly say Love, okay, and it's bigger profit margin. Right, that's simple. Okay, so who was more consistently profitable? So now we've got to look in the last year and just see, let's take UAL, 6.3% negative. That means our operations were, of course, losing money, right, on an accrual basis in those quarters. Ooh, and this quarter too. So 3 out of 4 quarters, UAL was losing money. And let's go look at Southwest at Love, positive, 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 positive. So definitely it's LUV, right? Because even though LUV is jumping around a bit, it's all positive. Okay, and what can we say about the COGS trend for each company and why? So if it's COGS trend, we're clearly going to be looking at this COGS margin, okay? And again, we're looking at during the last year. So remember, we have to compare what's going on with stuff like this year over year, because the COGS is going to go up and down somewhat with sales for these companies. So let's compare this to Q5, and let's compare this to Q6, and let's compare this to Q7, and etc. You get the idea now. So let's look at UAL. So UAL's COGS margin went from 81% to about the same, right? A little bit more than 80.5, a little bit lower than 80.5, then 79% goes to 84%. That's kind of a big jump. Let's see if that continued. 75% jumps all the way to 84% again. So for UAL in the last 2 quarters, at least the trend is up, big time. That's a big change, right? From 75 up to 84. Okay, and let's do the same thing with love here. I'm just going to look at the 2 most recent quarters. So we compare this to Q2, so 74 to 75, not too much, and Q5 to Q1, 68 to 74. That's a big jump. So UAL has been increasing for the past 2 quarters, and love has been increasing for the past quarter. Okay, so I'm just going to say here, both up recently. Okay, and as to why, I would definitely not ask you why on an exam because you don't know the history of what went on here. But just as a reminder, the price of oil was skyrocketing at that time, and they actually consider, it's a little bit counterintuitive, but they consider their fuel as inventory until they use it. So when the price of fuel is going up, their inventory cost goes up, their cost of goods sold goes up. So that's why. So in terms of the Y here, we've got the cost of fuel. Okay. All right, and as a last thing here, what I'd like for us to do is verify the computation of UAL's Q2 profit margin. See page 123. So what I'd like to do is I'd like to verify this minus 2.24%, because I need you to understand these numbers and how to think about these numbers to analyze the financial performance and health of an entity. But also, of course, I need you to be able to calculate them. So let's see if we can just go calculate this number. So let me just jump to page 123. This will just take a second. Okay, so what's on 123? I'll back up a little bit. Starting here on page 121, we have Appendix 1, and I've got the financial statements that we use to create all the ratio analysis we're looking at in this chapter for UAL. So let's give this a whirl. So I got balance sheets. Balance sheets aren't going to help us with profit margins, right? All income statement stuff. So here are the income statements for UAL. Okay. UAL, and we want Q2, okay, all right, and let's see if we can do this. So Q2 profit margin equals what? Net income over sales, and that's equal to, where's our net income? Minus 80 over 3570, and that's equal to minus 2.24%. And you should always check me on numbers like this to make sure you get the same answer, but I'm quite sure that you will get the same answer, that is correct. Okay, very good. So let's go back now to page 34 here. And next up, we'll see from there is our next type of ratio, which is going to be turnover ratios and also what's called efficiency ratios. So I think that makes this also a very good place to stop, take a little break, and we'll come back and dig into turnover and efficiency ratios. So see you soon.